Welcome to the All Access Podcast from the experts at Tevis. Each episode, we'll talk about technology topics, trends, or solutions that manufacturers need to know in today's rapidly evolving times. Sit back, enjoy the discussion, and let us know what you think.
Hello, my manufacturing friends. Welcome to the All Access Podcast. I am your host, Michael Thiessen. And once again, we are looking into the crystal ball and seeing what we can bring to you that is worthwhile and that keeps you up at night. And I have a good guess that nowadays, I think money keeps you up at night, or at least the news about money, inflations, and tariffs, and whatever is out there probably keeps you up. And so we over here at the podcast, we were thinking, you know what? What can we do so that you don't make emotional buying mistakes or emotional issues that are like knee-jerk reactions, and can actually utilize some of the knowledge and the know-how that is out there on that you make smart decisions. And you know, as so often we here at the podcast, we go to various conferences and shows and whatnot. And just recently, we went to the AMBA conference, the American Mold Builders Conference in Grand Rapids. And as always, there's lots of speakers and encouragement of what's going on in the market. And there's a gentleman that really intrigued me because he took away some of those fears, some of those worries from a lot of the manufacturers that were sitting in the room. And I thought, you know what? It might be the perfect person for us to have that crystal ball in front of him and to tell us what we should do so that we don't make stupid mistakes. Well, this individual, he is the key member of the ITR economics team. This team is built of economists and consultants. He is one of those people that loves to deal with data. He really goes in the midst of it, and he produces client reports and forecast reviews and economic researches and all the things that makes us afterwards feel much better with all the stuff that we're hearing in the news. So without any further ado, let me introduce you to Michael Fuse. He is really the brains behind all the things that are happening. And honestly, he kept me up, really interested in what's going on in our nation and in the world of manufacturing. Michael, welcome to the podcast.
Yeah, thank you very much, Michael. It's great to be here.
So there's a lot of things happening on, if you listen to the news, it changes from hour to hour to hour. Give me the synopsis of where are we right now in our economic state in the country when I look at manufacturing in particular.
Yeah. So to your point, right now, it's not boring to be an economist. We're actually at the point now where I get a little frustrated how quickly things are changing because I will be going on the road to speak, have an entire presentation and put together, and then the next day, the news cycle hits, and I'm like, nah, I got to go back and change things. The tables have turned, and it's a little extra work, but going back to maybe 2018, 2019, where things were just steady Eddie, and we were running out of things to write about. Now we have too much to write about. But overall, in the economy right now, there's actually more positivity than certainly the headlines and the sensationalism that we hear out there are letting on.
Okay.
And we spend at ITR the majority of our focus on the industrial sector, which we include in there manufacturing, oil and gas, energy, utilities, kind of to summarize the construction companies and organizations. But from a manufacturing perspective, we're actually starting to heat up. When I'm looking at a manufacturing series, manufacturing overall, I like to look at an economic series called Total Manufacturing Production Index. And the way we look at it is looking at those annual growth rates. Where are we year over year? and what direction are we moving? And right now it's accelerating and a rising, and we're actually up, but barely. It's like 0.24% above where we were a year ago,
Mhm.
but the trend is up. We're moving in a positive direction. So that 0.24 is rising. And if we look at the quarterly growth rate, I don't want to get too much into the weeds, which gives us a little bit of lead time. We'll call it a 312 at ITR. If you
Mhm.
remember from the presentation, it's at 1.1%
Mhm.
from the last 3 months compared to the same 3 months a year prior. So what does that tell us? That tells us that annual growth rate is going to continue to go up. So it's still kind of flat, but we're moving in this direction of momentum in
So at
manufacturing.
least we're moving in the right direction, I believe.
Yes.
Obviously, you mentioned earlier the sensationalism of the media. It kind of strikes fear in a lot of the manufacturers. Are we? I mean, you already said we're heading in the right direction. Where do you think this is all going to be going? Is it all going to be going away, meaning the tariffs and all that kind of stuff? What do you anticipate how long this will be around? And are the tariffs really going to cause that much disruption?
Tariffs in and of themselves aren't going to cause the disruption or thrust the US into a recession. I feel like that the R word, as I call
Mhm.
it's been thrown around a bit much. It's the uncertainty that's causing the pain, and even the certainty is elevated. We look at two series: economic policy uncertainty and trade policy uncertainty. Both are near record highs right now. And the risk there is when there's uncertainty, businesses just don't make decisions. We can't plan if we're not confident in the next 3 years. Good
Mhm.
news is that economic policy uncertainty I watch a little closer. It just has more of a story within the data. It's starting to come down. So that's good news. It's still very elevated, but it's trending back down. That's what we want to see it continue to do. Um, and it's not, again, if we keep it high or
Mhm.
elevated, it won't thrust us into a recession. The risk is it'll kneecap our growth. Like we're gonna grow.
Mhm.
The ingredients for the growth recipe is already in play in the economy, and we can talk about that. But what we're gonna do is limit how much growth we're gonna get if we keep uncertainty elevated.
Mhm. Do you see that the current manufacturers, and you probably talked to a few manufacturers here and there, do you feel like that they're heeding the advice and saying, "Yes, I know it's not as bad as it could be, but but I don't quite feel it or I don't quite see it," because they're still a little bit scared and timid?
It's I would say the main theme that we've been hearing, and I've been hearing when I talk to our clients that are good portion of our manufacturers, is we're getting a lot of requests for quotes, or they feel things building up, but the valve really hasn't been opened up yet because of that
Mhm.
uncertainty. And it's a mix. Some folks are starting to feel it. It really depends on where they fit in the overall and what sectors they're serving. Others are like, we still feel kind of flat, but we see the signs, and that's we're really encouraging our clients you should be using this time to make sure evaluating your capacity, investing, looking at automation, improving productivity, and because we see things continuing to go up, accelerating next year, and you got to be ready to maximize on that opportunity of growth. Like take what the
Mhm.
market's going to give you, and then take another 5 or 10% on top of it.
Right.
Yeah.
I remember from the MBA, you went very much in detail about the forecasting and how that company should do their forecasting currently by looking at their current input and output and kind of tracing it. And I think you even mentioned that, yeah, on your webpage you have a tool or some kind of a chart that kind of can give some details. I remember that sine curve
Yep.
as you're going through at your company. I mean, it's a lot of good insight. Now, do you see that companies are doing more and more of this forecasting and planning and in order to determine are we going in the right direction?
Yeah, the more they talk and follow ITR, the more they do. And I've heard so many times what we were referencing there, what we call is a rate of change analysis. And there is a 9-minute free video. It's on our website, it's on our YouTube channel. I highly recommend folks check it out. And if you're not doing it, to implement it. And it's taking any data series you have, your orders, your shipments, your sales, your revenue. I tell folks you need at least 5 or 7 years worth of data, but then you can start calculating your annual growth rate, which we call a 12-12 at ITR, and your
Hmm.
quarterly growth rate, which is a 3-12,
Hmm.
and comparing always where's my quarterly growth rate, the 3-12, where is it in comparison to the 12-12, gives you very strong indication of where you're heading, where the momentum is, and it's exceptionally valuable at the peaks of your cycle. So when you're growing really fast, things are going great, but it gives you a clear sign things are about to slow, and that's where you don't want to make mistakes. Or if you're in a rut and you have those, just we're human beings, we're emotional creatures, and we're short-sighted. We get in a lull, we think this is just how life's going to be the rest of forever, and we get things are going great, we also assume things are never going to go bad again. So also at the low, it'll start giving you a signal things are about to heat up. Are you ready? And that allows our clients that use it and folks that use and follow ITR and use that tool to be ready to maximize growth that's coming, and also be ready to like, hey, maybe we got to keep more cash on hand. Maybe now's not the right time for an investment or an acquisition or that CapEx spend, because things are about to slow down.
Now, this tool that you've mentioned, I mean, it goes into their data points so they can kind of predict when is a good time to do certain planning or purchases for machines or training and stuff like that. Because what we see on the software side quite often, when a company's slow, the owners try to hesitate and not wanting to do any kind of training because they're afraid of spending the money and because they don't know how long this lull is going to take and going to go on. And then when they're super busy, they're saying, oh, I don't have time to do this training right now because I need to get these work orders out. And is there ever, and from what I'm guessing is from your tool and from your data research that you assist your clients with, they can get a good understanding of where in that cycle they currently are in. Is that the right understanding that I get?
Yep, it's understanding where are we currently in the cycle, and there's 4 phases of the cycle, and I won't overwhelm anyone with that right now, and you can learn more about it on our website. And also, it's important to have when you're looking at your rates of change, that quarterly to annual, it gives you only a 1 to 2 quarter heads up where you're going. So it's not a huge lead time. So that's the real value too of having good economic indicators or using ITR, because it also understands how long are we going to be down or slow. And to your point, that is exactly when you want to be training, when you want to be investing in your people and your processes, because when that upswing happens, and it will happen, you want to be ready to go and pull the right levers at the right time to maximize those tailwinds that are giving you that lift. And once you're already in the accelerated growth, to your point, you don't have time, and you're going to leave a lot of meat on the bone. And the real value of ITR is understanding when it's coming, our clients working with us, so they can remain confident even when things are sluggish. Right? It's like, it's never fun during a down period. But if you understand, all right, we're going to have 2 tough quarters here, and then things are going to start turning around, I'm going to use these next 6 months to invest in training, to bring on this new CapEx spend, because I know we have the cash, and I know when I need the ROI on these inputs.
Do you see a lot of manufacturers follow that and contact you currently to see, okay, where are we right now? And you help them probably with that data to kind of come up with this. Do you see a lot of interest in that right now?
Absolutely, right now, especially as when the uncertainty goes up, people want that compass or that crystal ball. That I guess that is what ITR provides. We get a lot of clients. The place where I hear it the most is post peak. So they've been on a rise, things have been feeling good, and then they make a mistake at the peak. This is too much inventory. We overspent. Things slowed down. We have too many fixed costs, and they're like, I don't want to miss that again because we got burned. So it's more on the peak than on the rut. That because usually they're in the rut at that point, but they recognize it was the peak that killed us.
So you guys are going through a lot of data, usually looking at clients' data, you look at the market data and all of this. If you would present a snapshot right now of some of the manufacturers that you've dealt with, sometimes you can see that they're all almost syncing together, right? Because the market is kind of driving everything that's going on. Where would you say right now we are? Are we in the growth phase right now, coming on, going up the hill? Are we at the peak where we have to worry about that we're going to fall off the cliff? Where are we currently?
Yep, we are right in between, depending on where you are in manufacturing, but majority of manufacturing is either what we would call a phase A or just entering a phase B. Phase A means recovery. You're still down year over year, but you're cyclically rising. We're seeing some tailwind starting to form. We can feel the momentum, but we're not there to growth yet. And then the other half is we just got into that growth. We're starting to see that light now at the end of the tunnel, or maybe we're in the light now, where if you're in phase A, you're seeing the light. But it's very early still. So there's, even with the folks that have just hit that, what we are calling that phase B accelerating growth, there's a little bit of like apprehension. I get in the conversations like, I think we're there. I hope we stay here. I'm a little worried things won't keep accelerating. And generally, we're telling most folks we're going to get growth. We're going to through this year into next year, really the next 5 years. But it's probably not going to be as an accelerated a rise as the last time we had a period of rise. And that was because we were coming out of COVID, printed a ton of money, $6 trillion. We had that kind of sugar rush. And they're like, we're not getting a sugar rush this time, but we have a nice slow where the water's starting to boil, but it's been a slow boil up.
So you probably would say right now it probably would be a good time to kind of prepare for that storm that's going to be coming. In terms of, okay, look at your manufacturing, look at your processes, look at your labor force, look at your training capabilities, train up as many individuals that you can, get onto the latest technology, because my feeling is if that boom hits and then you're starting to do some of those things, then it's too late.
Yep. Our messaging has been 2025 is critical year for 26 through 29, because 25 is going to be a growth year compared to 24, but it's going to be your softest growth year of the next 3 years. And if you miss out on 25 in that preparation, you're not going to maximize that market share and that top line growth and the margin preservation, which is really going to be the big headwind for businesses the next 5 years of 26 through 29. And it's really this next 6 to 12 months. It's probably closer to that 6 months now. Like, you need to be leaning in right now on process improvement, training, getting your employees ready to go, improving productivity, improving capacity, so you're ready to go.
What about purchasing machines? Because interest rates are still not perfect right now. Do you feel that the interest rates might get better as we're continuing through 25, going into 26, or what would you say there?
That one's going to be a little bit on the not as good news. We will get a little interest rate easing over the next couple months and quarters. It will not be very meaningful now, though. And so our messaging there is, don't time your investments based on trying to figure out where the low's coming out with interest rates. It works out great. But at this point, the more important question is asking, when do I need the ROI from this investment? And that should be the primary North Star or guidepost right now in making CapEx decisions. Because if you need the ROI and you got to buy now to get it when you need it, you're not going to be kicking yourself that much based on, where the interest rates will be in September. It's better to focus on, when do I need to start capturing the return on this investment.
Now, you said earlier about the R word that everybody fears, recession, going into a recession. Obviously, everybody sees everything gets more expensive. They're fearing of inflation is going to be rising more and more. Do you see that we're going down that trend into that black hole, or do you see, no, we're going to pass that black hole completely? We're not going to go into this mini recession or whatever the media calls it.
Yeah, I don't. The chance of recession is never zero, so I don't want to say that. But the chances of recession are continuing to get smaller, especially as we are getting more certainty. We're moving past, and we never say it's zero. But the recipes for growth, the businesses are well positioned, consumers are well positioned. Savings, cash on hand, profitability are all very healthy. It's going to drive growth. So it significantly is continuing to diminish. Of course, there's always what we would call a black swan event too that could occur. And that's just outside of forecasting. That's always a risk. We're always writing our risks to every forecast we produce. Like, why could we be wrong? And of course, you're writing like China, geopolitical disruptions, war in Ukraine escalates, a lot of the, God forbid these happens, but we have to at least recognize they're out there.
It's this continuous moving target with everything that's going on. I mean, it's so, I'm going to say, uncertain, really, to say, like you said earlier, you prepare something for today, for tomorrow's presentation, and then all of a sudden something happens and it changes everything. So obviously, when you follow the news and all those things that are going on, the current administration is trying to ramp up that we're going to onshore a lot of the work back into the U.S. from some of the outsides. Maybe the tariffs are going to help. Do you see that more work is going to be coming, or is maybe already here at manufacturers? What do you see?
Yeah, right now, onshoring is happening, and it's not happening because of tariffs. I think that's the one surprising part. It's too early to judge if tariffs have been successful in onshoring jobs at this point back into the US. But since 2010, it's been a steady rise of onshoring into the US, and it accelerated exceptionally post COVID because the trust in China eroded, and we just decided we prefer shorter, more secure supply chains because we got burned during COVID. So all the jobs that are heading
Mhm.
back in the US, I want to say all, the majority. There's some early movers because of tariffs, certainly. I don't want to say none. But I would say the majority we're already
Mhm.
planning on coming back into the US. And I could pull up the data. In the past 20, we have data through 23, so it's a little dated. We should get the 24 data soon, but majority, it's under 200,000, but it was between 150 and 200, I believe, onshoring jobs. Actually, here I found it. 150,000 jobs were onshored in 2023, and
Mhm.
137,000 jobs were created due to foreign direct investment into the
Oh,
US.
wow.
That's promising without the tariffs, right? And now, so it's too soon to say tariffs are onshoring or are creating more jobs in the U.S. I mean, the one I guess leading indicator, we make our popes in America now, so maybe tariffs. Yeah, so maybe tariffs are working.
Oh yeah, yeah. That changed everything. But you know what? We deal a lot with our partners to the north and the south, with Mexico as well as Canada over here at Tebas. It's kind of interesting, this trend right now. I gotta say, I think Canada has been hit quite hard, and I don't think it was the tariffs. I think it was a lot of stuff that was already brewing, but I think maybe the tariffs kind of pulled it up to the forefront. Do you have any interaction with to our neighbor to the north and kind of see what's going on there?
Generally, Mexico, Canada, Europe, anyone outside the US, they're going to be hurt more due to tariffs. They're going to feel more of the pain. So recognize that. Both Canada and the Mexico, though, Canada's still growing. Industrial production still rising in Canada. They similarly have a lot of the growth. The recipe for growth. We see the next 5 years in Canada as growth years as well. And similar to Mexico. Mexico's benefiting from onshoring into their country. I guess we would call it nearshoring here in the US. Canada, there's been some disruption, but when we look at Canadian like real incomes for their consumers, they're rising. Real means deflated. So we're kind of deflating them so we can see how are they doing in regards to inflation. Can they deal with the pain? And similar to the US, they're in the positive direction. There's a little concern with corporate profitability in Canada. It's weaker than the US. Canada and the US do need each other. And what's interesting too is President Trump
Hmm.
strong negative views about trade deficits. He sees them as a negative. I see it differently. I don't see any problem with the trade deficit. I have a trade deficit with my grocery store. They've bought no economic reports from me. We have a great relationship. My life's better because they exist. But with Canada, when you actually control for oil and gas coming into the U.S., we have a trade surplus. They buy more from us than we buy from them if we control. So there will be more pain because of tariffs. Big advice, that I give for my Canadian clients when we're discussing that, how to deal with it is, one, there's no silver bullet, unfortunately, which is got a disappointment. But first, I would focus on cost control, input management, and that's, it's consulting mumbo jumbo if I just say let's cut costs. I'm looking source supply, shift supply chains, and from that point is, are inputs crossing the border multiple times? Like, are we overexposing ourselves to tariffs? And then it's also, so that's more of a risk management, and then looking at ways to further automate. When it comes to just arbitrarily cutting costs, I do caution against it, because I'm telling them the same things I'm telling my US clients. We want to take as much market share the next 5 years. So if anything's on the chopping block, we got to ask the question, does this inhibit our growth goals? Gotta be the main question. Next, I encourage them, like, US is going to be number one for you, for a market you want to get into, for the market you want to serve. and you want to grow. It's the largest market in the world. But can we expand to other regions? Let's look at the EU. Let's look at Latin America. Let's look domestically more. Can we be less US centric if I'm in Canada? And that's marginally less US centric. And then number 3, I'll tell them like tariffs are probably here to stay. Even if we look at Trump's tariffs in the first term, Biden kept them. President Biden kept most of them in place, even upped the lumber tariffs from Canada. So there's a relative agreement between the Democrats and the Republicans on tariffs. And Republicans just like talking about them more. So then we're talking about let's shore up our cash flow. Let's improve our margins. Let's strengthen our competitive advantages and understand what they are so we can improve customer loyalty, be more resilient, and be able to just deal with those headwinds. Because let's just understand they're probably not going away.
So you feel more that these tariffs are going to probably be staying there for a little bit longer period of time. It's not just a pressure tactic to get to the table. It's more or less that it's going to stay around for a little bit longer. Is that what I'm hearing?
That would be my guess. It's still uncertain what the goal of tariffs are in the U.S., and this is adding to the uncertainty. And there's 3 possible goals, and you can only have one because they all work against each other. Goal 1 is if President Trump and his administration, if tariff goal is to bring more jobs back into the U.S., if that's the primary policy goal, you're going to keep tariffs because you have to keep foreign competition more expensive than U.S. to help prop up the U.S. industry. Goal number 2 can be we want to raise revenue because we have a deficit. If you want to raise revenue, you don't want to reduce imports. You don't want onshoring necessarily because you want to keep the flow of imports so you can tax it via tariff.
Right.
So it contradicts number 1. And then number 3 is we want to we want everyone to get to the table. We want to lower tariffs across the board, and then they'll all go away. If that's the goal, you're not going to raise revenue and you're not going to onshore. So it's not fully unclear which one of those 3 it is. I think it's the first one. He even just, made the claim jobs are coming back and we're going to make so much money from tariffs. And I was like, well, that's 1 or 2.
Right. Well, seeing at least that there's at times some positive movement, especially at the UK coming to an agreement of some of the tariffs. I'm hoping that with Canada, we can come to a resolution hopefully quicker than later, because the longer this thing drags out, of course, the longer Canada will be a little bit in turmoil and struggling and feel a little bit more pain.
Yeah, and trade's such it's interesting. Like if me and you decided we were going to start our own little economy and we're only going to trade with each other, we're going to realize pretty quick, do you know how to make electricity? Because I don't. So we're like, oh, well, maybe we should expand who we trade with a little bit. And so like, oh, let's do our 2 towns. Okay. And then we're like, well, what about, you're in Michigan, I'm in Virginia. What about Michigan, Virginia? And then we're like, well, what about all of the U.S.? Yeah, that seems good. We're not worried about trade deficits between states. But then as soon as we run up into the border with Canada, we're like, I don't know about that. And I'm like, that was kind of an arbitrary place to draw the line. Like,
I'm glad that we're not into that. So I'm not starting my own town and doing all of this. But would you say that though the Canadian manufacturers right now, instead of throwing everything in the wind and giving up and closing their shops, because we have seen some companies close because of them fearing a little bit of what's out there and what's coming, and maybe it's going to stay around longer. Do you think they're in the same boat where you would advise them, and I think you already mentioned this, automate, train your people, do whatever you can to be 10 steps further so when it does open up, you're ready to go and you have all the technology in place, meaning technology, not buying frivolous machines and stuff like that, but preparing and automating for the future?
Yes, absolutely. I think there's even more pressure on Canada because of the tariff situation. There'll probably at least be the 10% baseline when we're all through this. And you want to be more flexible, be more resilient. And generally, our big message to our clients is the next 5 years, you're going to have no issue with your top line. Your top line is going to grow. The increasingly mounting challenge is going to be margin preservation and margin growth. So with Canada, we're going to add on top of that tariffs. That's even more margin pressure. So it's, what are you doing to train right now? What are you investing in automation and process improvement? So 1, you're more resilient, and 2, you're ready to rock and roll once we get past this uncertainty, and hopefully we can negotiate the tariffs down lower, at least from my opinion. But
what about the South? Are we in the same position there, or is the South of Mexico a little bit different?
Similar, same position, just different industries. Mexico is very overexposed to the automobile sector. A little bit different as well. When we look at jobs coming back into the United States, they tend to be more in what we would call call them high tech manufacturing. It's probably higher skilled required labor that's needed. The jobs that I would say is traditional manufacturing or lower skilled tend to favor Mexico, a little bit of a cost advantage pre-tariff, and it's very automobile.
Mm-hmm.
So the automobile market's in a bit of a rut right now, and it's what we've been forecasting, so we're not shocked. So Mexico's a little exposed to feeling that, plus the tariff situation.
Yeah, we're seeing the same kind of thing with the automotive industry. They're a little bit in a slump right now. A lot of the mold shops that are focusing only on automotive molds or automotive products are right now in this transition phase, not quite sure, are they going ice direction, is battery going to be moved a little bit more forward and all that kind of stuff. And from what we're seeing, at least from some of the clients that we've been dealing with, is they're looking with one eye definitely onto the aerospace industry, because it seems like that industry is booming and has a ton of job capabilities and jobs out there.
I think you nailed it. I'm going to repeat back exactly what you said. Automobile is going to be in a rut through the rest of this year. Even by the end of this year, we're forecasting it still to be down about 3% year over year for all North America. So Canada, US, Mexico combined there in that view. But next year, grow about 3.2%. But aerospace is one that's growing right now. It's in that phase B accelerated growth. It's up about 7.5% right now. We expect this year to end the year about up 5.7 year over year. And the next 26, 27, similar growth years. So a good place to pivot to. And you want to, I think we've learned you don't want to overexpose yourself to one, even more so because of just supply chain disruptions and.
Right. Would you recommend, though, diversifying right now is a good time to do it, or do you think it's a little late right now? Because if you're saying next year on the automotive, we might increase it again by 3.5%, are some of the manufacturers maybe thinking, you know what, I'm just going to wait till next year and see what comes? Or would you recommend, no, look into other industries, diversify, because these kind of things will happen more and more?
Yeah, I would encourage them to continue to look to diversify. And even if it's like a down year well, if you're looking for a new market, you want to look where the opportunity is. But I'll even tell folks, if your markets are in a rut, one, diversify, but two, $1 million of new business in a down year becomes $3 million of new business when when things swing the other direction. So a lot of it is, because I'll speak with a lot of sales kickoff teams at the beginning of the year, usually early on. And you got to always be careful with when you're talking to a large group of sales reps, because if you're telling them the markets are down, it becomes a self-fulfilling prophecy. What I want to say is, yeah, we're down right now, but here comes the upswing. What are you doing right now to get ready for it? $1 million right now of new business becomes $3 million 12 months from now.
Yeah. Yeah, I can see salespeople when they're down, it is very difficult to get them motivated, because they're saying, oh, yeah, everything's down, everything's doom and gloom. But seeing that it's ramping up again, that could get them into a positive mood and potentially be a huge benefit for their companies.
Yeah, I call it the tyranny of low expectations. We want to avoid it.
So tell me a little bit about ITR. What can ITR do for some of the manufacturers that are out there and are looking for answers? What can you provide to them?
Yeah, so a couple different areas, but the big overarching one is we've been around since 1948. So we're the oldest privately held, continuously operating economic consulting firm in the US. Over our history, we have a 94.7% forecast accuracy. Accuracy is important because it allows those who use ITR to plan with confidence. It's great to know we're going to grow the next 5 years, but it's even more important to know, when is that growth going to accelerate? When is it going to slow a little bit? It's going to slow a little bit in 27. That'll be a little sluggish year, but it will still be a growth year. So it's understanding, when do I pull the levers? What levers do I need to pull? And when is the right time to pull them? Because if you're already in a growth phase, accelerating growth, it's too late to do training. It's too late to bring on to expand capacity. And if you're already in a rut, it's too late to start getting rid of fixed costs. It's usually already needed cash on hand. And it's that idea of looking 3 years out, 4 years out, 5 years out, and being able to plan for the ups and the downs. So you can, one, if the market's going to grow 5%, if that's what your market is, you grow that 5 organic percent, and then you take another 5 because you're ready for it. So now you've grown 10. But we offer forecasting services for a lot of our clients, right? We forecast 3 to 5 years out, depending on what the client wants. Again, we're delivering the 95 to 99% accuracy typically. We have a trends report, which is like $20 a month, has 50 forecasts in it. I think that alone, $20 is well worth that, just to be able to get insights into key manufacturing, construction, the financial inflation side, and we write for business leaders, right? You listen to an economist on the news that gets brought in sometimes, and they're talking a lot of theory. They're probably trying to talk to congressional members more about what policy you should write. We're talking to business leaders about what's the reality, where are we headed, and what does that mean for you, and what should you do about it?
See, I knew we got the right person here when we invited you to the podcast, because you hit all the trigger points, and you hit all the points what companies should be doing right now, what their forecast should be to take that anxiety away. Because I think you said it earlier, a lot of these manufacturers are all emotional. They do things on an emotional basis, and some of them, and I'm not going to say all of them, some of them are actually diving into the forecasting, the economic side, and really doing their homework on it. Those are generally the companies that are probably being the more successful of. Some of these other ones, they're all emotional and doing things due to being scared or being over bullish and stuff like that. So I think you hit a lot of the right points and a lot of the right thoughts, and gave that in this podcast to some of these manufacturers. And I know I could be talking to you for quite some time. Unfortunately, unless I want to get pulled off from my assistant here, but I'm not going to do that. Any last thoughts or ideas or some tips that you can give to some of the manufacturers here to the US or even to our friends in Canada and Mexico, what they should be doing over the next 6 months or year in order to prepare for that storm?
Yeah, so next 5 years is going to be growth year through the 2020s. Big focus is got to be we're encouraging everyone. You want to have a plan to take as much market share these next 5 years. Big things to focus on that we've hit on is, especially the next 6 months, evaluate your capacity needs, improve efficiencies and productivity. Automate where you can, and reduce your need for labor growth, right? Protect the folks you have, your employees. But if your business is going to grow 30% and you're going to need 10, 15% more labor because of that, if typically, what are you doing to reduce that need to 7%? Because the cost of labor is going to be your largest input. Good people are essential, but what are you doing to make your current team more productive so you don't have to necessarily grow it as fast as you typically would? It's a great time to refinance debt right now. Lock it in, but avoid refinancing again to come 2029. Inflation is coming back. It's going to be slow. It ain't going to be a crazy ramp up, but by 2029, we see higher inflation environment, and you do not want to be refinancing that year. So that's important. And it's all about the margin battle the next 5 years. Your top line is going to do great. It's margin preservation and margin growth is where the focus has to be. And then audit your business. Well, that's what we're telling folks. And by audit your business, it's evaluating your products and your services that you're currently offering, which are most profitable and where's the juice not worth the squeeze. And can you improve those areas, or do you need to move away from them and lean into what you do well? And then lastly, I'll leave one other thing. Build out the service side of your business. The 2030s will be not as high a growth. It will be a tougher decade, first half, but it comes down to there'll be more maintenance retrofitting going on. And you want to make yourselves more stickier with the service side.
So where can they, I have to assume a lot of the listeners that listen to this have probably tons of questions, want to probably contact you. Where can they reach out to you, or what's your website address that they can find a lot of this information out and then get in contact with you?
Yep. So our website, itreconomics.com. You can find my picture, I think, under the speaking services side of it. But you can also email me. I'm always happy to do a quick intro or answer any questions you have. But it's my email is then FEUZ at itreconomics.com. So always happy to meet folks. Always happy to send over a few bullet points if anyone's got questions.
Awesome. Well, Michael, I'm really thankful that you decided to come on this podcast. I'm also glad that at the very end, you brought in the labor force and the retaining of employees, and then also these new employees that are emerging in the market, the youngsters, the new people. I'm hoping these new individuals are really enjoying the manufacturing circle, because there's a lot to gain in there, and it's a great industry to be in. More than likely, we'll have you on again to kind of see, all right, where did your predictions tell us to go, and where do we know? You said track rating that you guys have are phenomenal. And I love those individuals that are right on the target, because those are the people that the industry manufacturers should follow and trust. And we need more of you guys out there to kind of give our manufacturers the hope that what you just told them today. So thank you.
Yeah, absolutely. Would love to come back anytime. So thank you for having me.
Awesome. Thank you. Well, guys, my friends, you heard it here first. It is not as bad as the media makes it sound like. Do your research. Get in contact with ITR Economics to kind of understand of where you guys are in your company. Do the forecasting to see on which part of the cycle you guys are at. Can you do right now some of the downtime and do the training and do that really? I mean, I hate for you guys to invest in a lot of training when you guys are super busy, because I know it's not going to happen, and then you guys are going to fall back. So heed his advice, train up, look at the automation. There's a lot of automation that you can do if that's on the machine side, putting robots on there. But automation is not only about robots. It's about your processes that you do. Look at your processes, improve those processes so that you're mean when it comes back, because that's where it helps you guys out. This was fantastic. I really love talking to Michael, and I promise you, we will have him back later on in the year to kind of see where we've all ended up. I thank you guys all so much for listening in and tuning in to the All Access podcast. And we hope that you found our discussions always insightful and valuable as usual. And if you enjoyed today's episode, don't forget to just subscribe. You can do this on Spotify, on Apple Music, or wherever you get your podcasts. Feel free to share the episode with your network. Leave us a review. We'd love to hear back from you. And also, if you have an idea for a topic that you have not heard speak about, send us that message. We'd love to research it. We'd love to get into the weeds, so to speak, in order to help you guys out. You guys are important to us. You guys are manufacturers, and you guys are what this country is built on. For more updates, follow us on Instagram, X, and on LinkedIn. And until next time, keep shaping the future of your manufacturing. Thank you so much. Have a good day. Bye-bye.
Thank you for joining this episode of All Access. Please leave a comment or review with your feedback or what you'd like to hear in future episodes. To learn more about manufacturing technology solutions and Tebis's capabilities, visit our website at Tebis. That's TEBIS.com.